Hey everybody, welcome to this free edition of our Traders Weekly Roundup for the trading week ending February 9th, 2024. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is market power, but of course we've had market power since last November. Let's just take a look at where we are with everything so far as we go into the second full week in February. If we look at the index performance, you can see here everybody this past week was solid in the green, with Russell actually playing a little bit of catch up, still in the green year to date, down 71 basis points, but doing much better. NASDAQ up solid. NASDAQ futures up solid at 8.52%. I mean, the indexes, all of them ended higher this week, with the S&P reaching new highs, breaching for the first time the 5,000 threshold. But again, the advance remained very relatively narrow, all right, with the equal weighted version index. It did rally a little bit, but they're far behind the standard market weighted version, all right. So amazing how this thing is moving forward. The market picked up momentum on Wednesday, seemingly helped by the solid reception given to U.S. Treasury Department's record $42 billion auction, all right. So that helped out a pretty good deal. The auction essentially calmed fears that the government's record borrowing levels would push borrowing costs higher, thereby removing some of the Fed's power to cut interest rates if needed to stimulate the economy. But that kind of allayed some of the fears. You can see the PE ratio is still very high at over 22, essentially flat, the trailing versus the forward PE ratio. Dividend yield, 1.44 10-year Treasury, 4.18. So that's creeping up slowly when the markets are beginning to digest that, hey, maybe the Feds will not cut rates 5 times this year. The Feds are still adamant on just cutting 3 times. So we'll see how that plays itself out. The earnings yield is triple fours, 4.44%. The yield over the 10-year Treasury, 26 bips. So just barely, okay? And that still speaks loudly for 10-year Treasury holding up interest rate wise. And the VIX, it was up 4.44% for the week. If you look at the markets, they're up, but the VIX is slowly in a very stealth mode moving up as well. So you have to be very careful when you see that. All right. The week's sole economic surprise, arguably you could say came in this past Monday in the form of the S&P Global reading of the services sector. It jumped unexpectedly to a 4-month high, back into expansion territory. It came in at 53.4, so it's very strong. And we also saw the supply management gauge coming in at a solid 55.8. Now these are global measures, so that was kind of a surprise for the week. Treasury yields, as I mentioned earlier, they increased at the beginning of the week, kind of spurred by higher strong jobs report the prior week. And then we did see the Fed chair, Boom Boom Powell, comments on 60 Minutes this last Sunday. He reiterated his view that he saw no need to cut rates right away. So we're starting to see some of that filter into the markets, with the 2-year yield going up, 10-year Treasury, as you see, up at 4.18% to close out the week. Yet it still does not matter. Earnings are not great. They're not good. They're just kind of coming in at expectations, but we are seeing the lead by the AI themed stocks, especially the Mag 7, NVIDIA, Meta, Google, Amazon, Apple, Microsoft, as well as Tesla. Now, if we go across the shore and take a look at what happened in Europe for the week, you can see here Europe was just barely flat to slightly in the green. The FTSE was the only one in the red for this past week. They're also the only one in the red year to date. Euro stocks, which are the 50 largest companies in Europe, are up 4.28%. CAC 40, DAX, they're all in the green for the year, but just barely. Europe is close to, if not already, in a recession. So you could see the well underperforming indexes across Europe. Okay. The ECB officials, they also continue to warn against cutting rates too early, much like what Boom Boom Powell is doing here in the U.S. So a lot of analysts are concluding that the ECB is unlikely to lower borrowing costs before June. Right. So that is also putting a little bit of downward pressure on equities across Europe. Meanwhile, in the UK, Great Britain, economy appeared to be a little bit more resilient at the turn of the year, which could reinforce the Bank of England's reluctance to ease policy also. Their unemployment came in at 3.9%, while their PMI came in at 54.30 in January. So anything over 50, as a reminder, is expansion. So that also helped as well. Now, if we go over the Asian markets, the Nikkei is tearing it up with all the indexes, the main indexes that we follow. If you look at the year to date for the Nikkei in Japan, 10.26% leading the way. That's so abnormal for the Nikkei. And this is on back of a strong year last year as well. The economic data developments, however, continue to suggest that the Bank of Japan, their achievement of their 2% inflation target, is not quite in sight yet. We did get a report out of the IMF that said their latest opinion of the Bank of Japan's conduct of its monetary policy following a policy consultation with Japan, that it generally does once a year. They indicated that the upside risk to Japan's level of inflation has materialized in the past year, which is what the Bank of Japan wants. And that will allow them to wind down their still very unconventional monetary policy of stimulus and negative rates. They're one of the few countries that are still doing that, right? So I think it's going to be a good play for the yen, but just not yet, right? I know that a lot of people are front running it, and I had suggested if you wanted to front run it, you could, but stay very small because the big move hadn't come yet. Then, of course, if we go over to the Asian markets, you can see in China, they had a very strong bounce from a very ugly week last week. Remember, they were down over 6% last week, so they haven't made all that up from last week. But they were up almost 5% for the week, still down year to date. They've got a big holiday this upcoming week. They're going to be off almost all week. China always takes these long holidays, okay? We did get the Global Services survey out of China, and it was at a weaker than expected 52 in January. It was at 52.9. So it's coming in just a little bit. And the PBOC said in its most recent quarterly policy report that it would still keep policy flexible and precise to boost domestic demand. So the central bank is also forecasting consumer prices may rebound a little bit. But a lot of economists in China predict that Beijing is still going to need to introduce more stimulus measures, right? As the world's second largest economy, still grapples with the problems they have in the real estate sector. The one thing that I do want to do, let's go take a look at the charts here. Let me just switch you over real quick. We'll just do a quick roundup of where we are in the charts. You can see here, switching back to the U.S. markets, we made highs in just about every index this past Friday. And so if we're looking at the E-mini S&P 500 futures, intraday all-time high on Friday, up 4.9%, 5,048.50, right? We've had a huge run going into January, right? You can see as we kicked off January, we pull back, and then starting really around the 10th of January, we've just been on a tear, right? I do believe we are going to see some weakness as we go through the second half of the month. How much weakness will we see? Not really sure, but I think it's going to get soft. You can see the MACD is setting up for a divergence here, what we call in our group a poor man's bearish divergence, which does suggest we're going to pull back a little bit more. I think the softness will come. Predicting the timing of that is difficult to do. If we look at the let me just go find it on my screen over. We'll go look at the RSI. Let's move it over here like this. If we look at the RSI, you can see here we're well in overbought territory, right? We're similar to where we were right here, where it took over a week or so to pull back and then gain back again. So we're still well overbought here. So I do believe that we're going to see a little bit of a pullback here. All right, a little bit of a softening of price. How big the pullback will be remains to be seen. I think it's going to be soft, which tells us that we want to still be buyers of a dip. Okay. If we look at the Mag 7, you can see the Mag 7 also made new highs. This is a custom index of just the Magnificent 7. It came in at a high on Friday. It was up 13.53%, right? Seven of the big AI movers. You can see how strong it is. I do believe this will pull back as well. And you can see longer term, we're not getting any divergence. So that does suggest money still wants to pour in on any dip in the Mag 7. And that's kind of keeping the rest of the markets higher. Okay. Now, if we look at the NASDAQ Composite Index, nowhere near that strong. You can see, in fact, with the NASDAQ Composite, we still have not taken out our all-time highs made back in 2021. So for people that had a general basket of NASDAQ Composite Index stocks, right, going back that far, you'd still be underwater. Okay. So I do believe it will take it out, but we're just going to need some more backfill here. And the NASDAQ Composite is also showing some divergence here as well. Then, of course, if we look at the FANG index, which is driving all of the markets, there's no divergence in the MACD here. It made it made a high price here on the 9th as well, up 14.36%. Okay. We did pull back, fill this gap a little bit here, but I do believe we're going to come back and test this again over the next 2 or 3 weeks before we attempt to make another all-time high here. Okay. And then, of course, if we look at the Dow, look at the Dow, you can see the Dow is up. The last all-time high with the Dow was made on January 30th, up just 2.14%, right? So we're near or at all-time highs, and we're just kind of struggling around those areas. And of course, if we look at the equal weight also nowhere near as strong. This is what's lagging everybody. It did make a high price on the 9th, but not even up a 1%. I mean, it's just barely moving, slightly under 1%, right? Or no, slightly under 10 basis points, not even that. So this is kind of where we're seeing all of this. So all the money and energy, and you can see the MACD is setting up for another divergence, which is another pullback. So this is why I believe we're going to have this light little pullback here for a bit. Okay. And if we look at volatility here, this is what I've said. It's slowly creeping higher. You can see this regression channel. This started on the middle of December. The VIX has slowly been moving higher, even though the markets have been moving higher. And typically over a period of time when the VIX moves higher and creeps higher, when the markets move higher, the VIX is going to win, suggesting that the markets will have a little bit more of a significant dip in the action. And I don't mean, the S&P coming down maybe 20 points or 30 points. I'm talking about more like about 100 points, 150 points. But then buyers, I think, are going to step in. U.S. Treasuries, if we look at the interest rates, you can see the interest rates are starting to get the religion that boom, boom, Powell means it. We're near the 2024 highs in the interest rate move, all right? So that is just the market's view that they're slowly coming in and doing what boom, boom, Powell says, right? The markets are slowly pricing in. Maybe he is serious when he says we're not going to do 5 rate cuts. I believe if the markets are right and the bond market is right and we end up doing 5 rate cuts, it's not because the Feds can, but because they have to, meaning the markets are pulling back stronger than they think, okay, and being more ugly than you think, okay. So this is a little bit about what I see here. And of course, with the interest rates up, bonds are moving lower. And if we look at the bond market, it's coming back down to the lows of the year, right? Again, when bonds move lower, interest rates move higher, and that is to be expected. Okay. If we look at the currencies, the dollar obviously is stronger, right? You can see here we made the new 2024 highs here on February 5th. Obviously, with interest rates staying higher for longer and the U.S. economy doing stronger or stronger than Europe or the Asian markets, then everybody wants to be in the dollar. And here's the dollar right here. It's setting itself up for a longer term downdrift, but not yet. Okay. And then, of course, the euro is going to be just the opposite. The euro is going to be down lower. And remember what I said. Do not go long the euro unless or until it crosses the 50 EMA. If you want to play it when it crosses the 200 EMA, that'll be kind of front running it, meaning jumping in sooner than you really should. Because it could run right up to the 50 like it did here and then just roll back over again. I do believe there will be a time for the euro, but right now the Elliott wave count is suggesting any rally is going to be sold, where in the dollar any dip is going to be bought for the short term. Okay. And then of course if we look at gold, it's just camel humping along, up and down, up and down. There is no trade here in gold other than the trades that we run in our group, our user group, which works out really well for this kind of movement, right? So that's a little bit about what I'm seeing here in gold. And then of course if we look at energy, let's start with oil first. Oil, as you can see, is kind of in the middle of the range. There's the opening price, there's the high price, so it's kind of sitting in the middle. I don't see too much more upside of oil. You have the geopolitical risk premium if we do anything more serious with Iran. But outside of that, I think it's going to be limited in its upside and its downside. So again, with our members, and if you look at our option masters, we have some great ways to trade this. It's a good trade. But directionally, you have to, unless you're a day trader, trying to time oil where it is right now in the current price is very difficult to do. I just don't think the probabilities are on your side. And then that gas is getting to a point where I'm going to really like a long here. You can see it's moving way down lower than it should. If I put it on a weekly chart, you can see here this trade here with nat gas. We were long nat gas here. And you can see now we've taken out these lows. In fact, I have to go back all the way back to over here right in 2020, in the year of COVID, when nat gas was down this low. When they actually shut everything down, nat gas got down as low as 1.51. I don't think natural gas would get that low here. That's why I believe bullish plays here, opposite of this, dipping your toe in the water. And if you, for our members, if you go our option masters and look at how we do these trades, they're really fun trades. We traded this one all the way up in a bullish format, and it worked out really well for those of our members that took the trade. But if we look at this here, I do believe the downside is limited. Upside could be really good. There is no divergence here. That would suggest any move higher. The odds favor a little bit of a rollover, but there's ways to handle that in the way we trade this. All right, everybody, that's a real quick update on the markets this week. For those of you San Francisco and Kansas City Chief fans, should be a fun weekend. I know I'm going to enjoy it. Everybody have a really good weekend. Members, I will see you Monday morning in our chat room. Take care, folks. Bye now.